Hey best friends, Asian guy is here, and they just pulled the rug on us. They waited until the final trading day of 2025. They waited until volumes were thin and nobody was watching. And then they crashed the market. You're looking at silver trading at $70.50 right now. We've plummeted from $75 highs. We've given back all the gains from the last 48 hours, and if you're holding silver, your portfolio is bleeding. But listen carefully, because what you're witnessing is not the end of the bull market. This is a liquidity massacre driven by a specific banking regulation that forces the biggest banks in the world to dump assets and hoard cash on December 31st. In this emergency analysis, we're going to dissect why silver and gold are crashing together. We're going to expose the Basel III regulations behind this sell-off, and we're going to explain why this crash is actually the perfect setup for the January effect that begins in less than 48 hours. The banks are cleaning their books one last time. Do not let them take your position. This is the final flush before the surge. To understand why silver is dropping today, you need to understand what's happening in a banker's mind on December 31st. Today is not a trading day for them, it's an accounting day. At midnight tonight, regulators take a snapshot of every major bank's balance sheet. This snapshot determines their capital requirements for the next year. It calculates their systemic risk score, or G-SIB score. If a bank is holding too many volatile assets, like silver, gold, or stocks, their score goes up. When their score goes up, they have to pay billions in extra capital reserves. So, what's the logical move? Sell everything, dump the gold, dump the silver, get to cash. Because cash is the only asset that lowers the risk score. The massive red candles you're seeing aren't because demand disappeared. They're because JP Morgan and Citibank need to show cash to the Federal Reserve tonight. They're dumping positions into a thin holiday market to dress the window. This is purely mechanical regulatory selling, and because the market is thin, their selling has an outsized impact. They sell 5,000 contracts and price drops 50 cents. They sell 10,000 and it drops $2. But once midnight strikes, the rule no longer applies, the pressure lifts and capital can flow back in. This is why we often see V-shaped recoveries in the first week of January. The banks sell on December 31st and buy back on January 2nd. You're watching the sell leg right now. The buy leg is coming Friday. Let's look at gold. Gold is down $76, trading at $26.94. When gold sneezes, silver catches pneumonia. Because silver is smaller and more volatile, it amplifies gold's moves. If gold is down 2%, silver crashes 8%. This correlation confirms this is a macro liquidity event, not a silver-specific problem. When banks sell assets for cash, demand for US dollars spikes. The dollar index is rallying today, not because the economy is strong, but because there's a dollar shortage in the banking system to meet year-end requirements. This dollar spike smashes everything priced in dollars. But remember, liquidity crises are temporary. The Fed knows there's a dollar shortage, and they'll likely inject liquidity through repo markets tonight. When that fresh liquidity hits, the dollar will fall and precious metals will snap back violently. We're in the eye of the liquidity storm. Now the technical damage, a drop to 70.50, hurts the chart. It breaks the short-term uptrend. Technical traders will see this and say, the trend is broken, time to sell. This creates follow-on selling. Algorithms see the drop and pile on with more shorts. We're currently testing the $70 support level. This is the line in the sand. If 70 holds, this entire crash is just a backtest of the breakout. Old resistance becomes new support. If we bounce from here, it proves there's a floor of real buyers waiting. And looking at volume, we're seeing absorption every time. Price hits 70.50, buying volume spikes. Someone is stepping in saying, I will take your silver at $70. That someone is smart money preparing for 2026. Let's address the panic you're feeling. You saw 75 yesterday. You see 70 today. You feel like you lost money. But did you sell yesterday? No. Are you selling today? No. Then you haven't lost anything. You still have the ounces. The market transfers wealth from the impatient to the patient. Today, the market is testing your patience. It's trying to shake you out before the January rally. Think about the fundamentals. Does a drop to 70 change the debt ceiling crisis? Does it change that China is paying premiums? Does it change that mines are empty? No. The fundamentals are rock solid. The price action is just loud, painful noise. Let's pivot to the physical market reality. Silver spot is $70.50, so you should be able to buy an American Silver Eagle for $74. Right? Wrong? Go to dealer sites right now. Premiums have expanded. Yesterday, premium was $10. Today, it's $12 to $15. Dealers are refusing to lower prices. Why? Because they know this crash is fake. They know it's a paper event. If they sell you a coin for 74 today and price snaps back to 78 Friday, they lose money because they can't replace inventory. So they're keeping prices high. They're pricing in real value, not liquidity value. This disconnect is your signal. When spot drops but street price stays high, it means physical supply is tight. Nobody's lining up at coin shops to sell their stack. The only people selling are leveraged paper traders. You must trust the physical market over the paper market. The physical market is truth. The paper market is manipulation. Imagine your Tesla or Samsung with a budget to buy silver for January. Yesterday it was 75. Today it's 70.50. Are you sad? No, you're thrilled. You're issuing buy orders as fast as you can. You're using this dip to lower your average cost for the year. This industrial buying provides a hard floor. The price can only drop so far before industrial users step in and buy everything. We believe that floor is right here at $70. Below 70, the value proposition is too good to ignore. Factories will clean out the vaults. So while banks dump paper to fix accounting industry is taking physical metal, this accelerates the shortage. It moves metal from weak hands to strong hands. Once it goes into a factory, it never comes back. Let's talk about the January effect mechanism. Why does January 2nd matter so much? Because that's when new money arrives. Pension funds, endowments, 401k contributions. Billions of dollars flow into markets on the first trading day of the year. Right now, the market is illiquid. There are no buyers. That's why banks can push price down so easily. But on Friday, the buyers return. The volume returns. When that wall of money hits this suppressed price, we'll see a violent reversal. We could see silver jump from 70 back to 75 in one session. This is the slingshot. By pulling price back today, they're loading energy for the launch Friday. Do not sell at the bottom of the slingshot. Now the bear case, could this be the top? Could silver crash to 50? Technically, anything is possible, but fundamentally no. Not with the deficits we have, not with war risk, not with the debt. A crash to 50 would require a massive deflationary depression where factories stop working, and if that happens, government will print quadrillions, which sends silver to infinity. So the bear case is actually a hyperinflation case. There's no scenario where silver loses value in real terms over the long run. How do you handle the next 24 hours? Survival. Do not look at your account balance. Do not calculate your loss from the peak. It's a paper loss, not real, unless you sell. Focus on the ounces. Focus on long term. If you have cash, get ready. If we dip below 70 momentarily, that's the buying opportunity of the quarter. Be greedy when others are fearful, and right now, everyone is fearful. We need to zoom in on technical levels. When a chart prints a massive red candle like today, it breaks short-term structure, momentum traders got stopped out, trend followers are selling. We've broken support at 72. We're hanging on at 70. Why is 70 critical? Because it was resistance for weeks. It was the ceiling we couldn't break. Now that we're above it, it must act as the floor. If we close below 70, it opens the door to 68. That's the next major support. Is a drop to 68 fatal to the bull market? No. In the grand scheme, a correction from 83 to 68 is a normal Fibonacci retracement. It's technically healthy, but emotionally devastating. It wipes out gains of the last 2 weeks, but you have to separate price from value. At 68, is silver less valuable than at 83? Has utility changed? No. Has scarcity changed? No. The only thing that changed is the liquidity premium. The market is charging you less because it has less cash to bid with. That's a discount, not a devaluation. Let's talk tax loss harvesting. Today is December 31st, the IRS deadline. If a hedge fund bought silver miners at the peak in 2021 and they're still holding at a loss they sell today, why? To book the loss, to lower their tax bill on their Nvidia gains. They don't hate miners, they hate taxes. This creates artificial calendar-driven selling. And guess what happens? January 2nd, the tax year is over. Selling pressure vanishes instantly. The fund manager says, okay, I booked the loss now, I want the position back. So they buy. This wash sale dynamic depresses prices in December and explodes them in January. We're in the depression phase. The explosion is 48 hours away. If you look at mining stock ETFs today, it looks like a crime scene. Down 10%, down 12%. Investors are puking their positions. They're saying, if silver can drop $8, miners are too risky. But look at cash flow. Even at $70, these companies are cash flow monsters. But the market isn't pricing them on cash flow today, it's pricing them on liquidity panic. Miners are high beta. They're the tail of the dog. When the dog gets whipped, the tail snaps violently. But this snap creates opportunity. We're seeing quality producers trading at valuations that imply silver is $30. The market has disconnected from reality. If you have cash, this is where you look. You buy miners when there's blood in the streets, and today there's a lot of blood. The bond market. The 10-year Treasury yield spiked today. Why? Because banks are selling bonds to raise cash, just like silver. When yields go up, it tightens financial conditions. It hurts stocks. It creates risk-off environment. But here's the catch. The US government cannot afford higher yields. With $36 trillion in debt, every 1% rise costs hundreds of billions in interest. So the higher rates go today, the more likely the Fed intervenes tomorrow. The bond market crash guarantees the next round of money printing. They have to print to save the Treasury. And when they print, silver flies. So this crash in bonds is actually the precursor to the next leg up in precious metals. It forces the Fed's hand. We're watching the system break so the Fed can fix it with inflation. You own the inflation hedge. You're positioned for the fix, not the break. Let's look at the January 2nd setup. Markets are closed tomorrow for New Year's Day. This gives everyone 24 hours to cool off. When they come back Friday, they'll see silver at 70, they'll see gold at 4,300, and they'll see a world still short of resources. The bargain hunters will be waiting at the open. The pension funds will be waiting. The sell pressure from G-SIB rule and tax harvesting will be gone. This creates a vacuum up. Just like we fell into an air pocket today, we can rise into one Friday. Do not be surprised if we see a limit up open Friday morning. The market hurts the most people possible. It hurt longs today by crashing. It will hurt shorts Friday by ripping. The whipsaw clears the board. Now, physical delivery for January. First notice day has passed. The longs who stood for delivery are waiting for their warrants. With price crashing, you might think they'd walk away, but they aren't. Open interest in delivery month is staying high. This means buyers want the metal. They're not scared by the price drop. They're happy to take delivery at 70 instead of 79. This confirms the physical shortage. If buyers were speculators, they would have fled. The fact they're staying proves they're industrial users who need the atoms. The drain on vaults continues. Today's price action is a paper storm. The physical foundation is unmoved. Let's talk emotional capital. You have financial capital and emotional capital. Today you spend a lot of emotional capital. It's exhausting to watch your net worth drop, but you have to recharge, turn off the screen, stop watching red candles, go celebrate the new year. You can't change price by staring at it. Trust your thesis. Why did you buy silver? Did you buy it for a quick flip, or because the fiat system is mathematically doomed? If the fiat system is still doomed, the trade is still on, the timeline might have shifted, the path might be bumpier, but the destination is the same. Do not let a one-day liquidity event shake you out of a generational position. We need to map out recovery. The market has taken a punch, but markets have resilience. What does recovery look like? Is it a slow grind or violent snapback? Based on mechanics of this crash, the G-SIB rule, the tax selling, the thin liquidity, the recovery is likely V-shaped. Why? Because selling was event-driven, not value-driven. Sellers didn't sell because silver is worthless. They sold because the calendar said December 31st. Once calendar says January 2nd, the reason to sell disappears. This creates a vacuum. Sellers leave, buyers return, price has to move up to find liquidity. We could see silver reclaim 73 by Friday close. We could be back at 75 by Monday. The speed of recovery will match the speed of the crash. With price now reset to 70, the upside potential for January is even bigger. If pension funds enter at 70, they can drive it to 85 without it looking like a bubble. This reset extends the runway of the bull market. It gives us more room to run before we hit euphoria. So in a strange way, this crash saved the rally. It prevented a blow-off top that would have ended the cycle too early. Let's talk about short sellers who made money today. They're sitting on profits, but they know the game. They know about the January effect. They know staying short into New Year is suicide, so they'll likely become buyers. Friday, they'll cover into weakness. They'll buy back shorts to lock in profit. This adds buying pressure. Short covering is the most reliable source of demand after a crash. It puts a floor under price because shorts must buy to exit. Now, physical metal purchasing. One final time. Today, silver is on sale. Spot down 8%, but premiums remain high. When do you buy? You buy when panic subsides, but price hasn't recovered. Usually 24 hours after a crash. Dealers are currently paralyzed. They hiked premiums because they were scared. By Friday, they'll calm down. They might lower premiums slightly. If you can buy silver at 75 all in while spot is recovering, that's a steal. You're buying an asset that was 83 yesterday. You're getting a 10% discount on the future. Do not try to time the absolute bottom, you'll miss it. If you see metal available and price is lower than Monday, take it. The window closes as soon as institutional buying starts next week. When big funds start buying, physical inventory will vanish and premiums will shoot to the moon. Let's look at 2026. This is the year rubber meets road. The deficits are cumulative. We've drained vaults for 5 years straight. We're entering the 6th year of deficit. Mathematically, this is the year the warehouse hits zero. When that happens, the price mechanism changes. It stops being driven by speculation and starts being driven by scarcity. Scarcity pricing is exponential. It doesn't go up 10%. It goes up 100%. It goes until it destroys demand. We're looking at a year where silver could touch 150. It sounds crazy today, staring at a red chart. But remember, oil went from 40 to 1, 20 in 2 years. Commodities move fast when shortage hits. So don't let today's price action cloud your vision of next year's reality. The debt is still there. The solar panels are still being built. The missiles are still being fired. The fundamental drivers are stronger today than yesterday, because today the price is cheaper. A lower price, with same fundamentals, equals a better investment. So here's the final verdict on the year-end massacre. It was a rigged game. It was a regulatory flush, designed to save banks from capital charges. It had nothing to do with silver's value. It had everything to do with banking system mechanics. You survived it. You held the line. You didn't panic sell. You proved you are a strong hand. Now enjoy your new year. Celebrate that you own the only asset outside the system. You own the money of the people. You own the energy of the future. When the sun rises on 2026, the game restarts, the scores reset, and the silver market is ready to run. You were early. You were right. You are ready. Welcome to the year of the squeeze. Subscribe.